Welcome back everyone. So I'm going to mix this channel up slightly and I'm going to start talking about growth-based stocks more in the future. Now this isn't going to change my investment strategy for the ISA account, and for those aware I focus on dividend-based companies for the majority other than the ETFs. Now when I first started investing 6 years ago, growth-based companies were what I mainly focused on, and even to this day I still hold a lot of growth-based companies within other brokerage accounts. So for this series I'm going to pick one growth-based stock and dedicate a whole video towards it. So today I'm going to be focusing on Shopify. So what exactly is Shopify? Well, it's an e-commerce platform which enables anyone to set up an online presence to sell, generally speaking, physical products. Right now there consists of 1.2 million people using the platform and over 500,000 businesses that use Shopify for their online presence, and that currently spans over 175 countries worldwide. Now their headquarters are based in Ottawa in Canada, and interestingly most of their users come from Asia, North America and Europe. You can see a list on the screen. We've got China at number 1, US at 2nd, France in 3rd place, and then all the way on 10th we have the likes of South Korea. So this company does have a global presence. Now on top of that we have something called Shopify Plus, which is more of an enterprise version, and so merchants that generate from 1 to 500 million in sales are going to benefit from the Plus service. Simply put, the monthly costs are much greater, but there's lower transaction fees. There's also an increase in number of staff accounts and a high level of store customization, such as during the checkout process. And then we have Shopify apps. This is another area where Shopify makes their revenue. So they have their own app store which consists of installable apps, and this just helps to increase the sales for the merchants. There's a combination of free and paid versions, so it's a nice to have for anyone who has their own storefront. And then there's the Shopify theme, so there's free and paid versions out there which just helps with the aesthetics of the website, and they have the Shopify partner program where developers can be hired to further customize the site to the client's needs. So with that general overview out of the way, let's take a look at how the stock has been performing. So I have Yahoo Finance on the screen and I'm just going to enter the ticker symbol SHOP. So first up, let's take a look at the PE ratio. This is currently at 564, and as we remember, the PE ratio is to act as a comparison between other similar companies within a given sector. So in the case of e-commerce, there's not actually too many rivals out there. One of the bigger ones that I can think of is that of Amazon, and they currently have a PE ratio of 97. So although it's unclear to know what the standard average is for this e-commerce sector, we can roughly conclude that the trade-in price of the stock is somewhat overvalued, given that it's over 5 times that of Amazon. The actual price of the stock is at $914, so that is something to be aware of if you plan on investing. So next up, the market capitalization. That is currently valued at $111 billion. Now most of the time I pay little attention to the market capitalization, given that the value is calculated by multiplying the current stock price by the number of outstanding shares, or in other words, the shares held by investors. Nevertheless, it shows that this company is valued to be worth an insane number, and that is the value that us investors have put on the price. So earnings, we currently have an earnings date scheduled for February 2021, but let's take a look at how the company has been performing in the past. So this type of graph is somewhat consistent with other types of growth-based stocks out there. We have revenue increasing year on year, but then to our disappointment, we have the earnings that are decreasing year on year. Now, unlike dividend-based companies, when it comes to growth-based companies, we need to be more comfortable seeing earnings decreasing. And of course, that's a weird statement to make, given that you want to invest in companies that fundamentally make more money than they spend. But companies out there that focus on this scale factor, where they try to gain as many users as possible, they are willing to forego profits if it means they can have more market share. So although the financials are important, for an investor during the early phase, the earnings is what we're more interested in. And so we have the blue circles on the graph here, which is just the estimate, and then we have the actual values, which is the green dots here, and we can see that every quarter the actual value has exceeded expectations. And so the key takeaway here is that we have actual earnings beating expectation. It's not just a one-time thing. This has happened throughout the most of 2020. We should note though that Q4 of 2020, they have set an estimate of 1.28. So we should see a smaller difference between actual versus estimate going forwards. Now let's switch over to Trading 212. I have my investor account, so you can see some of the growth-based companies that I hold. I also have a lot of other rubbish companies out there. Those are just the free shares that I received during the early days. I will sell some of these eventually, but if anyone's interested, there is a link in the description where you will receive a free share. I don't actually receive any commission on that link, but if you wish to sign up, you'll get that free share. And we can see that I have Shopify invested already. I have shares that add up to a whopping 0.01, and that's because I'm aware the stock price is overvalued at the moment, so I just invested a small amount there. But let's bring the graph up. So same as before, entering the ticker symbol. And it's been a while since I've done any form of technical analysis. I used to feature this at a basic level during the early days, but since the pandemic, it's been near impossible to figure out where a stock is heading, and even to a lesser extent when it comes to dividend-based companies. But for growth-based companies, we can perform a basic technical analysis, and I would argue that for growth-based companies, it's somewhat more important when you first enter the stock position. So right now I have the 1-day graph on. That just means every candlestick that I have consists of how the company performed during that given day. And so let's just bring up one of the tooltips. Now at the moment we have the price that is resistant at around this level here. So our first resistance level is around 856. Already the stock price has come close to testing that value. And so should the price drop even further than that, we're looking at around $713. So these are the two resistive points that we have to play with. In my case, I normally go for a percentage higher than the actual resistive value so I can lock in the stock. So my entry point will probably be around the $745, and I would set this once I see the price drop past this first resistive level. Now, it could be the case that this price continues to climb, so you could always set a small portion if we ever hit around the $850 mark. But those types of decisions are entirely up to you. This is just how I would try and enter into Shopify. And given that we have higher values such as the 1,100 mark, this stock could easily hit this value and then increase higher up as well. So what do you all think about Shopify? And if you enjoy this type of content, do let me know in the comments below. There's other growth-based stocks that I'm happy to talk about, but if there's any that you want me to cover, then do let me know. So thanks to all those new subscribers out there, welcome to the channel. I primarily focus on dividend-based investing, but as you've seen from this video, I'll be talking about growth-based companies as well in the future. If you enjoy this type of content, then do give it a thumbs up. It definitely helps out the channel. And with that said, I'll catch you in the next one.